Emergency funds: why have it and where to invest it? Preparing for sudden emergencies and securing future finances form the crux of ideal financial planning. We have covered the following in this video. The importance of an emergency fund. An emergency fund is an essential corpus that you must keep aside to tackle emergencies. It is a fund that you can fall back on at the hour of crisis, or for unexpected and unplanned scenarios, and not for meeting your routine expenses. So, you must design it specifically to meet unanticipated financial shortfalls that may apply to you. Why keep emergency fund liquid? To be in a position to cover unexpected expenses is the reason why an emergency fund should be liquid. It is the most critical feature that you should keep in mind when you are choosing where to park your emergency fund. You should be able to withdraw the money when you need it and with no delay. At the same time, you should ensure that you do not get penalized in the form of an exit, load or withdrawal penalty. The value of the amount invested should not go down either, and must deliver excellent returns. How to build an emergency fund? An emergency fund cannot be built overnight but is done gradually. Set aside a particular amount every month in a different bank account. Soon it will grow into a considerable corpus that you wish to have. Say, you have decided to have an emergency fund of Rs. 1 lakh. In this case, you can set aside Rs. 5,000 or Rs. 10,000 every month to accumulate the corpus you need. It is fine to even cut down on your investments to build this amount. One. Savings account. A savings account is the most common type of emergency fund. These accounts are designed to help you save for unexpected expenses, such as medical bills or car repairs. 2. Money market account. Money market accounts offer higher interest rates than savings accounts and allow you to access your funds more quickly. 3. Certificate of deposit (CDS). CDS are a type of deposit account that pays a fixed rate of interest over a set period of time. 4. Credit card. A credit card can be used as an emergency fund if you have a low interest rate and enough room on your credit limit. 5. Home equity line of credit. HELOC. A HELOC is a line of credit secured by your home that you can access when needed. 6. Peer-to-peer P2P lending. P2P lending is a form of crowdfunding in which individuals borrow money from other individuals. 7. Retirement accounts. Retiring funds are a great way to build an emergency fund, as you can access them without penalty. 8. Life insurance. Life insurance can provide you with a lump sum of money to help cover. A long-term emergency fund is an important part of any financial plan. It is a separate savings account that is specifically set aside for unexpected expenses that may arise in the future. This fund should ideally consist of 3 to 6 months of living expenses, and should not be dipped into unless absolutely necessary. This fund should not be used for day-to-day expenses, or frivolous purchases, and should be replenished when possible. Short-term emergency funds are funds set aside specifically to cover unexpected costs that may arise. This could include medical bills, car repairs, or other expenses that can't be paid from regular income. These funds are typically kept in an easily accessible account, such as a savings account or money market account. Short-term emergency funds are funds that are set aside to cover unexpected expenses or emergencies that may arise. These funds can be used to cover medical bills, car repairs, home repairs, or any other unforeseen expense. They are typically kept in a separate account that can be accessed quickly in the event of an emergency. In order to have a successful emergency fund, it is important to have an adequate amount of savings set aside that can be used in the event of an emergency. Short-term emergency funds are funds that are set aside for unexpected expenses or emergencies. They are typically kept in a savings account, money market account, or short-term certificate of deposit (CD), and are easily accessible in case of a financial emergency. These funds are typically used to cover costs like unexpected medical bills, auto repairs, or job loss. It is recommended to have 3 to 6 months' worth of living expenses saved in your emergency fund. Emergency savings. An emergency savings fund is a crucial part of your personal finances. No matter your greater financial goals, eliminating debt, improving your credit score, saving for your kids' college, saving for retirement, building a sufficient emergency savings fund is the first step to a financial healthier, wealthier you. Your emergency fund is the life preserver you keep in case of a financial emergency. It keeps you afloat, so you don't drown in unexpected bills. A surprise vet bill, an urgent trip to the hospital, an unavoidable car repair, all of these can quickly derail your life, and force you to rack up high-interest credit card debt or miss other bill payments if you don't have an emergency fund. So how big does your financial life preserver need to be? The first step, no matter what your life circumstances, is to save up 1 month's worth of take-home pay, i.e. the amount after taxes are deducted. Once you have this amount in your emergency savings account, you can focus on growing it to your personal savings target, while also tackling other goals. Those general saving targets are often called the 3-6-9 rule, savings of 3, 6, or 9 months of take-home pay. Here are some guidelines to help you decide what total savings fits your needs. 3 months. 3 months of take-home pay is a good emergency fund target if you are currently a renter, do not have dependents, i.e. children, have a steady paycheck, have a reliable safety net. A safety net includes friends and family who could give you a place to live, a car to drive, part-time work, or some other form of help if your situation turned dire. Of course, you could match the above description perfectly and decide to save up more than 3 months' income. If you do, you'll be less reliant on your safety net should something stop or hinder your stream of income. 6 months. This savings target applies to the largest group of people and is probably the most commonly quoted emergency fund goal. 6 months of take-home pay should be safely tucked in your savings if you have kids, you have a mortgage, your household has 2 steady paychecks. Any combination of these qualifies you to join this group of savers. Single with kids and renting, shoot to save 6 months' income. Married and live in a condo, still 6 months. If your household has 2 steady incomes, you should aim to build your emergency fund equivalent to 6 months of take-home pay of the highest earner. Want to be doubly safe? Calculate 6 months' income based on both incomes and sock it away. 9 months. If saving 6 months' worth of paychecks sounds intimidating to most people, 9 months may sound ludicrous. But there are situations when this is the ideal amount of money to have in case of a rainy day, or a few rainy months back to back. If you or your significant other are self-employed or work freelance full-time, you belong in this group. When your income is unpredictable, the bigger impact an unexpected bill can have on your life. A larger emergency fund not only helps protect your family from feeling the pinch of slow business or an unexpected bill, but it also helps protect your career. Without a sufficient emergency fund, a few slow months of work may force you to switch careers and return to a 9-to-5 job. The 3-6-9 guidelines for emergency savings can be helpful and give you peace of mind when building your emergency fund. But remember, they're guidelines and not hard rules. If your gut says you need 4, 7, or 10 months saved up based on your income, expenses, and past experience, go for it. Thanks for watching. If you enjoyed this video, please make sure to subscribe to our channel for more great content.